A generation afraid of mortgages is betting thousands from a phone. Not on a casino floor, not in some back room. On glowing apps between short videos, group chats, and market alerts. Young traders are turning risk into routine. Some begin with $100 per trade. Some post screenshots showing $232,000 balances. Others claim $16,000 gains in a single day. Then a mother clip appears, and someone says they lost $152,000. This is not just investing. It is a cultural shift. Gen Z avoids many old risks. Less driving, less drinking, less dating. But when money enters the screen, hesitation can vanish. Options, crypto, sports bets, prediction markets, leveraged ETFs, they all start to feel like doors out of a broken system. Then the door starts to look like a trap. Gen Z is usually defined as people born from the late 1990s to the early 2010s. They were children during the great financial crisis. They watched families fear job losses, collapsing portfolios, and in some cases losing homes. Then came another shock. Many entered college, work, or adulthood during the pandemic. Life moved online. School, friendships, shopping, entertainment, and money all collapsed into the same device. So when trading apps arrived with bright buttons and instant charts, they did not feel strange. This matters because young people are not entering the same economy their parents did. Homeownership feels distant. Rent keeps climbing. Weddings, children, and stability feel expensive before they even begin. The old bargain looks broken, and when the slow path looks blocked, the fast path starts to look rational, even when it is dangerous. That is the question underneath all of this. What happens when an entire generation stops believing the safe route still works? The strange part is that Gen Z can look financially strong on paper. Some data suggests young investors hold more money in financial portfolios than earlier generations did at the same age. Yet they are also less likely to own a home, and that changes everything. A stock account can grow fast. A house gives security. When the second feels impossible, the first becomes a battlefield. Young workers also face a harder job market than the headline economy suggests. Overall, unemployment may look stable, but unemployment for younger workers has hovered around 7%. For young male college graduates, some measures have resembled recession-level weakness. That contradiction creates pressure. A person can be told the economy is healthy while sending out applications with no answer. They can see markets near records while being priced out of rent. They can watch older people build wealth through assets they can no longer afford. Then comes the feed. A creator says trading is easy. Another shows a huge gain. Someone else explains options like a video game strategy. The message is simple. If you can scroll, you can trade. That line is powerful because it removes the gatekeeper. In the past, sophisticated trading belonged to professionals at hedge funds, banks, or trading desks. Now, a 20-year-old can learn option spreads, leveraged products, crypto rotations, and macro narratives from short-form videos. Knowledge is everywhere, but so is illusion. Seeing winning trades all day makes winning feel common. Losses are quieter. Bankrupt accounts do not go viral as often as screenshots with green numbers. And that imbalance changes behavior. This is where financial nihilism enters the story. The phrase was popularized by podcaster Dmitry Kofinas. It describes a mindset where traditional routes to security appear so damaged that extreme risk starts to feel reasonable. Why save slowly if the target keeps moving? Why wait decades if the cost of entry keeps rising? Why follow rules that no longer seem to pay out? That is not greed. That is despair wearing a trading hoodie. Researchers from Northwestern University and the University of Chicago found something chilling. When people begin to give up on owning a home, they often consume more, work less, and put more money into risky assets. That is the trap. If the future feels unreachable, the present becomes louder. Instead of saving for a house that seems impossible, a person may chase the one trade that could change everything. A risky bet stops feeling reckless. it starts feeling like the only remaining strategy. Surveys show a larger share of Gen Z and millennials feel financially behind and believe they need to take risks to catch up. Gen X and boomers tend to feel more secure and place more trust in traditional investments. That gap did not come from nowhere. For roughly 2 decades, young investors grew up watching a mostly rising market. Someone who put money into the S&P 500 10 years ago saw returns averaging about 15% a year. That is unusually high by historical standards. There were sharp corrections, but the market recovered. The lesson many learned was not patience. It was that dips are temporary, risk is rewarded, and the screen eventually turns green again. Then trading became entertainment. Apps turned markets into something closer to social media. Charts refresh instantly. Confetti-style rewards once appeared in some platforms. Notifications create urgency. Watch lists feel like scoreboards. A trade can deliver a hit of excitement faster than a paycheck. And that changes the meaning of investing. Academic research has long warned that excessive trading hurts individual investors. Many trade too often. They lose money through transaction costs, bad timing, and emotional decisions. They buy what has already surged. They sell what has already crashed. Still, the behavior spreads. The U.S. options market shows the shift clearly. Options were once mostly the territory of professionals. In recent years, trading volumes have broken record after record, driven in part by retail traders chasing fast moves. A contract can double quickly. It can also go to zero. That is the seduction. The upside is visible. The cliff is hidden until you are already falling. This is why the line between investing and gambling now looks blurry. Buying a stock for the long term can support a company that hires people, builds technology, and grows over time. Betting on a short-term price move is different. Betting on a sports result is different again. Yet, on a phone, they can feel almost identical. One tap buys a stock. One tap buys an option. One tap places a sports wager. One tap enters a prediction market. Press, wait, win, lose. The gesture is the same. The consequences are not. Some young traders do make real money. One retail trader described starting with $13,000 and making $109,000. For someone watching rent rise and wages stagnate, that story is magnetic. It suggests escape without permission, but the same ecosystem shows devastation. A trader can be celebrating one moment, then staring at a 6-figure loss the next. The clip of someone losing $152,000 is not just content. It is a warning with a human voice. Risk appetite also changes by place. In the U.S., young retail traders have shown strong interest in high-risk products.
South Korea has become known for heavy trading in leveraged ETFs.
In Europe, the pattern has been more restrained, with more money historically kept in bank deposits or safer fixed-income products. Governments there have even tried to push more people towards stock ownership. China shows another contrast. One study found Gen Z investors there were more risk-averse than older Chinese generations. They were also more likely to put money into gold, an asset often linked with caution and preservation. So this is not just youth being careless. It is a collision between technology, culture, inequality, and broken expectations. Gen Z grew up with smartphones and instant search. They are used to finding answers alone. Do your own research is not just a phrase. It is part of their identity. But markets punish confidence without discipline. Social media shows wealth as a lifestyle, not a process. Cars, apartments, watches, vacations, balanced screenshots. They all appear without context. Viewers see the prize, not the risk-adjusted path that produced it. And sometimes there was no path. Some posts are exaggerated. Some are lucky. Some hide losses. Some sell courses. Some turn financial anxiety into engagement because fear and envy keep people watching. The casino learned vertical video, and once risk becomes content, losing money is no longer just a private mistake. It becomes a performance, a lesson, a meme, a confession, or a warning. The market does not just take capital. It takes attention. That is the new machine. It does not need a person to walk into a betting shop. It lives inside the same phone used for class, work, friends, dating, shopping, and news. It arrives through notifications. It waits inside group chats. It hides inside jokes. The danger is not one bad trade. The danger is a lifestyle built around volatility. Because volatility does something to the brain. It trains people to expect sudden transformation. It makes ordinary progress feel insulting. A raise feels small. A savings plan feels slow. A balanced portfolio feels boring. Then boredom starts to look like failure. That may be the deepest shift. Previous generations were sold stability. Gen Z is being sold escape. Escape from rent, escape from low wages, escape from student debt. Escape from the feeling that adulthood has been delayed, priced up, and placed behind a wall. If that is the emotional starting point, risk does not look like a game. It looks like a ladder. But not every ladder is built to hold weight. Options can expire worthless. Crypto can collapse. Leveraged ETFs can punish bad timing. Sports bets can drain money one tap at a time. Prediction markets can make uncertainty feel tradable, even when the outcome is still unknowable. The product changes. The pattern stays. A person feels behind. A platform offers speed. A feed shows winners. A trade promises a shortcut. A loss demands a bigger bet to recover. That is how hope becomes a loop. The danger is not that Gen Z is stupid. That is the lazy explanation. The real danger is that many young people are making rational decisions inside an irrational environment. If housing feels impossible, wages feel weak, and traditional wealth building feels too slow, then a risky trade can look like hope. That is what makes this moment so powerful and so dangerous. Risk is not evil. Markets reward risk when it is understood, sized, and survived. But risk taken from despair is different. It does not ask, what can I afford to lose? It asks, what else do I have? That question can destroy people. Gen Z is not merely gambling with money. It is gambling with time, trust, and belief in the future. And if the slow path keeps disappearing, the next generation may not choose safety at all. When a generation stops believing in tomorrow, every bet starts to look like survival.